Point of this next 5 minutes is to find the cost of equity, which for Starbucks, I came up with 6.43%. This is what was hard entered into the model template is 20%. So as Home Depot showed us, there's a really big difference in present value between a 20% discount rate and a 6. If you don't have very much debt, it's going to be driven by this cost of equity discount rate. And the method I'm getting ready to walk through is the capital asset pricing model, which I think we said in the notes. I quoted Bill Megginson is saying it's a horrible method, but it's the best we have. Paraphrased him anyway. But the way the method works is you download or you look at close prices for the S&P 500 and for your stock of choice. Now I'm pointing at adjusted close because there's each day a stock opens, it hits a high, it hits a low, and then it has a close. But some days they split shares or they pay dividends or things like that. And that's worked into this adjustment. So anything that we do to analyze price performance, we want to look at the adjusted close. They may or may not report volume. Oh, the S&P doesn't report volume here, but Starbucks reports volume. The only thing that's of interest to us is the adjusted close for the S&P 500 and the adjusted close for the stock. What we want to do, I've taken 60 points of monthly data here, so 5 years of monthly data, and calculated a monthly return. There are two ways to calculate returns. One is the way we calculate our annual growth of sales or so forth. The other is to take the natural log of the current price over the previous price. And either this gives you a continuous return, the other gives you a periodic return. Either is really sufficient for this, but the textbook I used for this uses the continuous return. So the natural log of the current price over the previous price, and then just copy that down. So we'll get 59 points of that, and then do the same thing for the stock, 59 points of that. Create a chart. You don't really need the chart, but the chart helps me explain it. What we're doing is we're plotting those monthly returns on Starbucks versus the monthly returns on the S&P. And then we put a trend line through it. The way we do that is we right click on any of those points and say add trend line. And can you see this format trend line dialog box?
Yes.
Okay.
Yes, we can.
What you want is a linear trend line. So you just want a best fit line through that. And you want to display the equation as well as the R squared on that chart. I've already done that, so I won't do it again, but this is the equation, y equals mx plus b, and the R squared, 0.3381. And we're going to recalculate those numbers here in a moment. But what that's saying is that when the S&P 500 has a good month, then usually Starbucks also has a good month. When the S&P has a poor month, Starbucks usually has a poor month. This line is of interest for two reasons. One is the slope of that line. If the slope were exactly 1, it would say, well, every time on average, the S&P went up 10%, well, Starbucks went up 10%. What if Starbucks goes up more when the S&P is up, and if it goes down more when the S&P is down? That would mean it had a high beta. So a beta of 1 would mean they perform similarly. A beta higher than 1 means that Starbucks is more risky. So on a good day, we tend to gain more. On a poor day, we tend to lose more. The other thing we care about this line is not just the slope, but the intercept. So where does that line cross the y-axis? So if m, the slope of this line is beta, y equals mx plus b, or y equals beta x plus alpha. Alpha is the y-intercept where this line crosses. And what that says is on a day when the S&P was neither up nor down, on average, what's Starbucks going to do? Well, if Starbucks tends to be positive, even when the S&P, when the broader market doesn't change any, that's a good thing. That's a positive alpha. And so people create websites like Seeking Alpha, because if you can find a stock that has a nice positive alpha, then regardless of what the underlying market's doing, you're likely doing better. And so Y equals beta X plus alpha. In this case, alpha is very slightly negative, 0.0009. I'm sure if we used a very slightly different set of numbers, that could go positive. So it's essentially 0, but it's the beta we care about. The beta is 0.8867. An easier way to get beta is with this formula. Excel has a slope formula that says if you take those two same arrays that you cross plotted over here, put them into the slope function, then it will calculate the slope of that line, which we said was beta. So if you go out and look at Starbucks on Yahoo, the summary, you'll find a 0.89 beta for Starbucks stock. So that's how they get that number. You can use it off Yahoo. The textbook where I found this usually recommends using it off Yahoo, but this is how you can do it if you want to. I like this because it always reminds me that looks like a shotgun blast to me. It's one thing to talk about betas and alphas. It's another thing to look at that cloud of points and realize I don't have a lot of confidence in that being too repeatable. But on average, over the last 5 years, that's how it's worked out. That's why they say this is a terrible model, but it's the best one we have. R squared is some measure of that. If R squared were 100%, then that would say that the stock were tied directly to the performance of the S&P. I think what we're saying here is that about 34% of the stock's movement is because of what's happening in the broader market. Another reminder that it's not all about beta. Nonetheless, that's how the model works. So if we have beta and we're willing to make an assumption about the risk-free rate, which I looked up the 10-year treasuries before class, and I think it was about 1.94%. Expected. And then if we're willing to make an assumption about the expected market return, 7%. Now, I probably should average, well, these would be monthly. I'd have to calculate the annual, convert it to annual. But if I'm willing to make an assumption about the long-term market performance, then I can calculate the cost of equity. And instead of using 20%, and that comes in the template, I can calculate a much more appropriate number based on three things: the beta, which I've calculated, and these two things, which I can get historically. I can get the current risk-free rate from 3-month treasuries. Some sources will tell you 10-year treasuries, other sources will tell you, but it's probably going to be 2% or less for risk-free rate. And then I can make some estimate, educated guess about what the market return is going to be in the future. Remember, what happened in the past doesn't matter here. We're discounting those cash flows based on what happens in the future. So if this formula has 3 inputs, and one I got to in a pretty rigorous way, the other two, I'd like to know what's the sensitivity to that. So you guessed it, we're going to come over here and do a data table. So yeah, the 10-year treasury said 2%, and I feel like historically the market has probably returned about 7%. But let's look at the sensitivity to that. So let's see, how does beta vary? I do a data table like you did on the midterm. Oh my. Once again, like you did on the midterm, your row input goes into the risk-free rate, and your column input goes into the expected market return. Then you see that when it is 2 and 7, I do in fact get the 6.43% cost of equity. But if the market doesn't do so well, maybe I should use a little bit lower cost of equity. If I was to, or if I wanted to be more optimistic on what market returns are going to be, I should use a little bit higher cost of equity. Similarly, if the risk-free rate isn't as high as 2, maybe I should use something a little bit lower. I think it's going to be higher. Maybe I should use something a little bit higher. I don't talk nearly enough about why we use data tables. I spend most of my time talking about how, but this shows us the sensitivity of that. I feel like the difference between 5 and 9% on the market return is probably about the same range of uncertainty as the difference on risk-free rate from 1.5 to 2. And if I'm right about that, then I'm seeing that the cost of equity is a lot more sensitive to return on the market than it is to the risk-free rate. So if I wanted to spend some time building more confidence in this number, I should probably spend more time thinking about what the long-term market return is and not worry too much about what the risk-free rate is. That's about all I have to say about cost of equity, that we can get a much better number than the one that comes pre-populated in the template. Any questions on this? Okay, this is posted out there. All you need to do is go to Yahoo Finance or somewhere, download history for your stock. You don't need all these extra columns, but if you want to just paste them in and make sure your dates line up with these dates, if you're even 1 month off on that, it would throw everything off. None of these points would correlate with each other. Questions, comments, so I can be helpful on your models.
Question about your source that you prefer to pull your returns, S&P
Okay.
and Starbucks returns.
Well, I would have told you Yahoo. Let's go to Yahoo. See what happens. Yahoo Finance. What's your company?
Kellogg.
Was that KG?
It's just K.
K. Okay. So let's see if we can find K. And we want to go to historical data. And let's pull 5 years, historical prices, monthly. And when I apply that, I still have a download. So for Kellogg, yeah, Finance or Yahoo Finance would be my preferred. I found it difficult to find any measure of the S&P that had this download hyperlink. And when I researched that, it basically gets down to licensing issues. And so what I suspect is for individual stocks, you'll be able to find what you want here. And I don't know that it's any better or worse than any other site, but that's where I get it. And it brings in those columns that we talked about. If you needed the S&P, I just flipped it off the screen. So one thing you could do is just copy this. I have to get the headers. And I think if we paste it in there, call it K, it would be as simple as that. Does a beta of, I'm sorry, does a cost of equity of 4.8 sound reasonable for Kellogg and a beta of about 0.56? Sounds reasonable. I'm going to go back to summary on Yahoo Finance, and I see a 0.59 there, 0.56, 0.59. It's pretty close. So probably got that one right. I checked Home Depot today, and they didn't report a beta. I'm not sure why. Maybe that team can tell me. But yeah, Yahoo Finance is probably as good as anything else.